In my opinion, we will undoubtedly reach new heights. That one is easy. The speed of this major geopolitical monetary reset will determine how high the market rises, but oh my, we could be approaching 5,000 soon. And let's not forget about the equities. Assume that $400 worth of gold comes to you. Going to 4,500 or even lower is going to attract a lot of investors. So gold stock prices will be much higher than they are currently. This is in addition to the valuation increase and everything else. When you see gold prices between $45 and $5,000, you'll notice that all the seniors are going to be twice as rich as they are now. These corporations are moving at a snail's pace. Climb higher in response to robust demand from investors and the central bank. Although he was hesitant to estimate when gold prices will rise exactly, precious metals expert Adrian Day was very confident in a substantial upward trend. The speed of further geopolitical and monetary upheavals, he stressed, will determine a lot. They predicted that the price of gold may reach $5,000 per ounce in the near future, and that a drop to $4,500 per ounce would significantly affect gold stock prices. He elaborated that if gold were to rise to those prices, the net present value of mining operations and their cash flows would also increase, supporting higher stock valuations, and the increased interest from investors would cause senior gold stocks to surge far beyond their current valuations, so big cap gold stocks are still reasonably priced, and Day thinks there's a lot of room for growth even after the recent advances. Day also said that there were indications of changing investor behavior by the end of August, when inflows of about $300 million occurred over 2 weeks, even if outflows for the year were still $3.5 billion. Even though it's still in its infancy, he emphasized this as a definite evidence that regular investors are starting to gravitate toward gold. Subscribe, like, and share this video if you thought it was helpful. We'll keep bringing you professional analysis and commentary on the monetary and geopolitical issues impacting the world today. I mention this for 2 reasons. First, that even if you don't like every single one of the senior stocks, you should still consider them good bargains because we're only discussing stock price and not company performance. The first is the fact that gold stock prices have risen sharply so far this year. Everyday Americans, like the dentist in Oklahoma or the registered financial advisor who says, "I think we ought to have 2% in gold," or who is always fielding client calls, are investors who know very little about it. From the flows into the GDX and the GDXJ, up until the latter week of August, you can see that these people have just begun to turn towards gold. In other words, the GDX saw enormous and persistent outflows right up until the middle of the 3rd week of August. Just give that some thought for a second. Massive funds are fleeing GDX, despite the fact that gold prices are at record highs, and stock prices are rising by 50, 60, and 70%. As of last week, I'm not sure about today, there had been 2 weeks worth of inflows into the GDX, totaling over 300 million, and so far this year. So far this year, you have still lost 3.5 billion. Outflows of 3.5 billion from the GDX have occurred, which, when you consider it alone, is my loss. Once again, I interpret this as a sign that the average investor who isn't crazy about gold is suddenly starting to see its value. After all, it only took a couple of weeks for the swallow to make a spring or summer, right? A change in direction, and a substantial one at that, is definitely occurring. Thus, that is the primary. It pains me to think of the day an Oklahoma dentist contacted his local investment advisor, someone who had no idea what they were talking about, and suggested that they get exposure to gold. Just what is this man up to? A simple expiration doesn't entice him. Their price to cash flow ratio is lower than it was 5 years ago, but it's higher than last year. So it's not overpriced. You could figure it out using net present value and all that jazz. Just so you know, I'm not implying that equities are dirt cheap right now. I'm referring to worth, not cost. Neither are they as overpriced as they were in January, but neither are they as cheap either. Their valuation isn't as inflated as it might seem considering the recent surge in gold prices. This is because as the price of gold rises, not only does the net present value increase, but so does the value of the mines. This is because as the price of gold rises, the cash flow also increases, correct? So, no, but prices are still rock bottom. Big cap companies, in my opinion, will continue to be a good investment opportunity for everyone. Plenty of work still ahead of them. What I say is known to us. Instead of predicting a time, try predicting a price. Yes, and you specify when. Therefore, I will not be all right. In my opinion, we will undoubtedly reach new heights. That's an easy one. The rate at which this massive geopolitical monetary reset unfolds will determine how high we go. But my goodness, we might well be approaching 5,000. Well, it wouldn't shock me. The Starks, though, we must not lose sight of them. Assume that $400 worth of gold comes to you. For the conservative, this is it. Actually, it's still $400 away. Allow me to introduce them to you now. There is a $350 difference. Assuming gold drops to $4,500, the price at which gold stocks would be trading would be far higher than where they are today. Yeah, since raising the price and valuing the company higher will attract more investors to the cash flow, then I can be of use to these businesses. So, you'll see 45 to 5,000 gold and all the seniors will be twice as rich as they are now. Adrian Day elaborated on how March has seen the beginning of the unfolding of many of the themes discussed earlier in the year. Despite rising gold prices, he said, North American investors were still on the sidelines, thus gold stocks lagged behind. This was due to the fact that central banks throughout the world were buying gold, both officially and unofficially. He went on to say that central banks still hold the majority of the world's reserves, but that diversification is more important now that the dollar accounts for about 47% of their assets on average, down from 75% when he first made the observation. He also mentioned that senior gold stocks still offer good value and could appreciate in value even after all the gains this year. Although gold is nearing all-time highs and stocks are climbing 50 to 70%, gold exchange-traded funds, ETFs like GDX and GDXJ, saw massive outflows up until mid-August, indicating that mainstream investor participation is still in its early stages, as he pointed out. Ordinary US investors and advisors with little prior exposure to gold has only recently started showing interest. Now we may return to the interview. The major event, or my main theme from March, is finally starting to materialize, so I guess some of the things that we and other people have been discussing are finally starting to come to fruition. I should preface this by saying that I don't speak for everyone, but the main point was that while gold is clearly doing well due to central banks, non-official Chinese buying, and other sources, North American investors simply aren't involved in the market, which is causing gold stocks to lag. Of course, that narrative is starting to change now. Yeah, I suppose we could address that later. Even though we're only halfway through the year, I'm still of the opinion that gold stocks are a good investment. Gold has been in their hands. For instance, the leverage is still lower than what is usual. For instance, if you examine the gold market over the past 18 months, you'll see that it's increasing by 40%. The previous time gold increased by 40%, gold stocks increased by 3.5 times at that time. About every 1.5 or 2 times, they're up. I won't say that I'm unhappy about the 70 to 80% gains in gold stocks this year. Nevertheless, there are reasons why North Americans and I will get into this. They still aren't providing us with the leverage that we're used to. While it's true that North Americans are just now starting to participate in this market, it's also worth noting the dollar's historically dominant role in central bank reserves. For example, at the turn of the century, the dollar accounted for nearly 80% of all central banks' foreign reserve assets, which was $7,578. We don't count pounds if I'm a Brit or the Bank of England. Yeah, as a result, I am highly focused on everything else. I could care less about the dollar, gold, Trump, or any of that. Wow. Holding 80% of your reserve assets in just one currency is insanely concentrated. The SSC would be all over me if I did that on my farm. Anyhow, I digress. We've already brought this up in March, so it's not like this is something that started with the current president. There has been this pattern for quite some time, initially at a very slow pace. Thus, we progressed from 75. Assuming 75% of reserve assets were held abroad in 1999, approximately 65% would go toward funding institutions like central banks that move at a snail's pace. This is a significant drop, particularly considering that they were really making more money during that time. Thus, the reduction was shocking. What about the time when Trump took office? Last year we were just starting off. We had likely dropped to 55%. My best guess is that I caught a glimpse of a figure not long ago. About 52% or thereabouts was my guess. Yeah. The most recent figure I saw was 47%. It was from the ECB, but I'm not sure. Seriously, I can't believe you don't believe this. Yes, non-French speakers are also on the rise, but what I'm getting at is that the rate of change has been accelerating, from 75 to 65 to 55, and then from 55 to 52 a few months ago to 47.5%. That's quite a change. But that's irrelevant to me. The weaponization of the dollar, which has persisted for quite some time, and even predates the present administration, remains intact. However, diversification is still sensible even without that, and it has only served to increase the incentive. So, when will it really end? For the time being, I believe central banks to be in a dominant position. Having said that, let's begin with the following. If you own 47% of your assets in US dollars, this varies from person to person, of course. The level of urgency is lower than when you held 75%. But if the weaponization of the dollar is a real concern of yours, then it's too much. Given that Russia has obviously no US dollars and exited the US debt 5 years ago, the correct amount may be zero if you're really concerned about them snatching your assets. The World Gold Council recently surveyed central banks and found that some countries' dollar assets must be far lower than 50% of their total assets. It asked what they plan to do in the next 12 months, and as you might anticipate, most of them responded they would be increasing their gold holdings. Nobody on that list has indicated they intend to decrease their holdings. So, I do believe that central banks will maintain their buying behavior. Now that people are starting to see it, there's extra push due to the economic shift and the geopolitical shift. The important issue is not whether or if your audience is well informed, but rather whether or not they like you and me. Is it the main theme? That's what matters. Yes, and I believe that the change in assets focused on global reserves is now the most important thing. But investors and the rich are also paying attention. It's not only the central banks, as we discussed. Basel III also states that gold is a primary asset. So there are a lot of factors. Gold's return to the global monetary system is being fueled by strategic purchases by Chinese central banks and rising awareness among investors in North America. With price-to-cash flow ratios lower than in the majority of the previous 5 years and potential for additional upside as net present value and cash flows grow alongside gold prices, senior gold stocks continue to be inexpensively valued even after strong gains this year. As a result of regulatory frameworks like Basel III, the US dollar's dominance in global reserves is gradually dwindling, and central bank portfolios are increasingly including gold. This shift in monetary policy is happening at the same time that ordinary investors are starting to put their money into gold ETFs, a sign that its value is being more recognized. For the future, gold prices have the potential to soar to unprecedented levels, sending senior gold stocks soaring and drawing in an influx of new investors. This would further solidify gold's position as a fundamental monetary and investment asset. What effect, if any, could the change in central bank reserves have on these prices and equities? In order to ensure that you do not miss any of our weekly updates, please subscribe and hit like if you are interested in receiving insights on the financial system backed by real data. We appreciate you watching the film and hope you find it entertaining. The transcription was performed by turboscribe.ai. Remove this message by subscribing to Unlimited.